Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. I'm Craig Jeffrey, your host. Our episode today is Working Capital 2.0, optimizing accounts receivable and accounts payable, strengthen suppliers, improve visibility. I have three great guests today: Sean, Jeremy, and Michelle from Kroger, Progression Services, and Monkey. Welcome to the podcast, gentlemen.
Thank you.
Thank you.
Thanks, Craig.
Well, I wanted to start out our discussion about the challenges. Everyone knows access to capital is crucial. I think Monkey is Money is Key is the name of your organization, Michelle. But what are some of the key challenges for working capital financing that, as treasurers, you're finding today, or as you're working with treasurers, you're seeing today? Who would like to go first?
Well, I'll speak from my side and this is Jeremy Reedus with Progression Services. I will give you a quick background on myself. I have grown up through Treasury, love it. As a matter of fact, it's probably the most interesting aspect of finance that a lot of people don't know about. So with that, we have a number of questions and challenges that others in finance don't quite enjoy or understand. So with that, one of them is this question about working capital and trying to adjust for it, because Treasury touches everyone, yet we own nothing. So in this particular case, the challenges are always going to be pretty standard across every industry. It's liquidity, visibility, forecasting is always a challenge. Then you have to, once you decide on what type of trade finance you want to look at, now you have to understand about your costs and your availability of financing. And then there's always compliance and making sure that you're still within boundaries of your debt structure. There's data quality gaps. There's just a slew of things. So challenges, there's not a shortage of them, but solutions is why we're always listening to what's on the street, what's a new way to look at an old problem.
Great. Thanks, Jeremy. That's a great list of things. Sean, you want to jump in?
Yeah, I would just add, from my point of view, as a practitioner now and one who sat on the other side for a long time, being out and about, talking with companies, access to funding at a supplier level, if you will, is always been a challenge. Of course, affordability of that funding is even a bigger challenge. And then with interest rates, with where they're at now, they're starting to go the right direction for a lot of folks, but they're not the historic low that they were, years ago. So pricing is difficult. And then, in general, I think there's just some sophistication challenges out in the space. And I think as service providers in the space, they deal with as much as their cool technology, if you will. They deal as much of trying to convince people that that's something that they need, and then also helping those companies become a little bit more sophisticated in their approach to how they manage working capital and and what solutions they put in place. So there's a lot of challenges in the space. As time goes on, there's more and more things that are happening with non-traditional banks that kind of raise red flags for some people who are trying to figure out what they should do next. And so I just think that when you take all of that, it kind of creates an environment that's very unique for service providers in the space to go out and not only solve the immediate need that's needed, but also bring the industry along to a better place.
I like that. Thanks, Sean. That little bit comprehensive look at the industry. And so, Michelle, you've heard Jeremy and Sean talk about a few of those items, and you work with so many companies. Are there other ones that you would want to highlight in terms of the challenges around capital? Or
Yeah, it's really amazing the topics they both provided. We call everything they just mentioned working capital 1.0, which is all the challenge related to the pricing, visibility, liquidity, and especially challenge with the effort from the procurement teams in terms of heavy lifting, organizing, managing, and negotiating with suppliers. I will include that as well. So we understand that the making sure the treasurers can see real-time pricing specifically. When I mean real-time is real-time. Every invoice coming from the account receivable and account payable, they should be able to see the best real-time pricing in the market. It should be very important. We love to provide that kind of information for them. We call that democratizing credit and information in terms of visibility. But also in terms of technology that Sean mentioned is very important. Not only provide the technology on the payment process, specifically about the effort that procurement need to reduce in terms of supplier negotiations as well. So using AI with that proposal is also an important topic for Monkey Tech. So not only to reducing fraud perspective, but also negotiating with the suppliers in that topic as well.
Okay, so that you're getting to the, what do you call it? Working capital 2.0, where it's not just access to the capital, but there's some other flexibilities like democratization of capital and real-time aspects of it. Kind of, is that a fair way to say it?
Yeah, absolutely. We call 2.0 working capital based on three main topics. One, real-time access to the best interest rate. With many different funders specifically. The second point, reduce dramatically the effort from the procurement in terms of managing, onboarding, and negotiate with suppliers. And the third topic is about visibility. Visibility, not just about a dashboard that you can see what's going on, but make sure you can change and upgrade your program as many times you want. We see a lot of global companies challenged about what's going on in the US or Latin America or Europe. Sometimes best practices, they cannot approach different countries differently. So they should be able to see any banking relationship, supplier relationship, and any credits related to that immediately and provide any change they want.
So visibility and self-service.
Absolutely right. Absolutely right.
Oh, excellent. Yeah, thanks for stepping into that. Maybe since we've already thrown out and defined the terms working capital 1.0, accessing capital, the democratization of tech, and spreading that out, there's a couple other terms that we should go to. So working capital, who wants to define working capital? There's at least two definitions for that. Who wants to define that? We've got 5 definitions at least we'll throw out.
Current assets minus current liabilities. I mean,
said like an accountant and a banker, right?
Is there any other calculation? I mean, math is math, right?
Well, the other one is like a treasurer oftentimes looks at net working capital or working capital, where it's receivables plus inventory minus accounts payable,
which is what I was
takes
going to
cash
say.
out of it.
I apologize, but yeah, as a treasurer, I look at that, so that's my definition. So I think this is a perfect segment, because from the treasury standpoint, I would look at it from the working capital formula, basically net working capital. So it's going to be your inventory and your sales minus your DPO. So it's a little bit of a difference, and it's great to understand how everyone looks at the same subject and comes up with a different answer.
Those are good and useful, right? The accounting definition, and bankers use that for, do you have the ability to cover your obligations as they come due? And the other one is, are you working with AP and AR and inventory to optimize that component of it, right? And so the difference between, if I take AR and convert it to cash, that has a difference in the second definition. The first one, those are both current assets. So different purposes, different reasons. They both make sense for different purposes. So that's one. And then the next one is liquidity versus cash flow. How would you describe that?
From my perspective, I will say that liquidity is always the substratum of a company. You want to make sure that you have funds available. Cash flow is just kind of an indicative look of how we are directionally, including all of the accounting entries and expectations that go forth. But liquidity is how we live day to day.
I tend to look at it, Craig, as I oversimplify everything in my professional life, and maybe that is a challenge for me. But liquidity is what it is. It's, are you liquid enough to be able to function, right? I mean, that's the simplistic version of it. Cash flow really is those variables that you were just talking about. It's how quickly is AP growing or getting smaller? How quickly is AR growing or getting smaller? And same with inventory. Those elements drive that flow of cash that are coming in. And then you have some of the other things that are elsewhere on the balance sheet or the income statement that impact that cash flow for sure. But for the most part, if you manage those three things and where they're supposed to be and making sure that AP is growing, AR is smaller, inventory is not growing, And I say it that way because inventory has to be just right to meet the need of whatever your business is, whether it's manufacturing or if you're in retail and selling something. So cash flow is the speed at which those balances kind of ebb and flow, and how well can you really manage it on a daily basis to make sure you're meeting your needs plus your shareholder needs. That's how I look at it.
That's perfect. I would say liquidity is like about access to cash. So make sure you have access to it. I like the cash flow kind of movement of money. So treasurers like Sean and Jeremy, they talk about one example is different perspective of DPO, for instance. Negotiating DPOs is one example of cash flow, etc. So yeah, and it's interesting we are seeing treasurers wanting to work on both ways. So like how can it get better on both type of financial challenges.
One of the terms we didn't throw out or phrases was cash conversion cycle, but everyone talked about receivables, payables, and inventory, right? It feeds back in and out of cash is part of the business. So that's a bonus term for everybody who's listening in. EBITDA, earnings before interest. Maybe someone could define that and talk about direct versus indirect impact on EBITDA, right? If you're not used to treasury or finance, that just sounds like gobbledygook. Who'd like to take that one?
Happy to start. I would call to, as I want to simplify, profitability. So get what kind of profitability you are adding into the company's cash, I would say. It's more measurable kind of thing. How profitable are you? And then you're adding more profitable kind of cash into your company.
So yeah, so earnings before interest, taxes, depreciation, and amortization. So everybody who loves accounting knows what all those things mean, but the summary was clean. Anything else on that one before we move on? All right. The next one is dynamic discounting. Dynamic discounting.
I'm happy to take that one, Craig, since I spent 9 years of my life with one of the major players in the space, especially in the retail industry. So, dynamic discounting is providing early payment to your suppliers, but leveraging your own pile of cash in order to pay those suppliers early. And so there's solution providers out there that create an environment to where the suppliers can come in and make an offer to their buyer to get paid early. And so, I would say 10, 12 years ago, that was kind of a growing thing, but dynamic discounting's been around for a long, long time. And it's just probably been within the last, like I said, 10 or 12 years where it's kind of gone really mainstream with really good solutions that are out there. There's, 2 or 3 really major providers in that space that have really brought a lot of value. And dynamic discounting, to tie into the last conversation we were talking about with earnings, can have a direct impact on the earnings because it's going to lower the cost of goods sold for the buyer as they get those discounts off those original invoices. So it's a great solution. It's out there. It's been out there for a while. It's kind of a play on the old version of the 210 net 30 type thing, but it's a little more dynamic because the supplier can make the offer what makes sense to them, and it doesn't have to be the same offer every single time. It might be more, it might be less, just depends on the needs of the supplier at that time and how quickly they need the cash.
Yeah, so if it's like I can pay now, but it's the 12th day, I won't get a discount. I'm just going to wait. Now I can still get a percentage of that. Excellent. The next one is supply chain finance or an auction-based model. And so maybe we could explain what that means. Supply chain finance.
Jeremy, you want to take a stab at that, or?
Yes, I was going to say exactly. Yeah, I'll take a stab at it. So ultimately for supply chain finance, it depends on this health of your company from a cash perspective in some regards. How fast do you need to bring cash in? And so sometimes as companies that are a little more financially strapped, and I've worked for small companies that have needed such programs, and I've also worked for large ones that can just outweight any changes in terms. But from a smaller company standpoint, is trying to accelerate and actually work with your procurement team on a consistent basis to stretch out your payables. So the treasury mantra has always been fast to bring money in, slow to push money out. And so supply chain finance, from my experience, has been one of the great tools to do so. So if we are currently giving terms at a net 60, and yet we want to move to a net 90, the supplier is not going to want that. They want to be paid at their 60. However, if you give them an opportunity to participate in a supply chain finance program, they should be able to get paid at 60 or even move it further up if they want to by taking advantage of it. And typically, we've worked with our banks to do so, and it's a lengthy process, and it's definitely going to be an all-inclusive process of working with procurement. But from a liquidity standpoint, from a cash flow perspective, it is well worth it.
Yeah, I guess I would say one thing on that too. If we look at supply chain finance, there's normally this binary: I pay you later, you get paid later. If I pay you earlier, you get paid earlier. It's this win-loss, and supply chain finance has that. I think, as you were mentioning, right, there's a third party who's putting funds in there, perhaps, or a third party could put funds in there. So I can still pay later, and you can still collect funds earlier. There's a scale in there. So we change it from win-lose or pure binary to a third party that creates some optionality or flexibility there.
Yeah, and Craig, the big difference between that and dynamic discounting is, like we said, with dynamic discounting, you're using your own cash. Supply chain finance uses a third-party cash, whether that's a bank or a non-bank provider or somebody like that, to actually pay the supplier early, and then the buyer has the promise to pay in the future. And that's what Jeremy is saying. You get the terms opportunity there to be able to hang on to your cash longer.
Well, thank you each for your input so far. It'd be great to just hear a little bit about each of you. Share what your company is, what it does, and what's your core responsibility or your remit. Let's go with Jeremy, then Sean, and then Michelle.
I'm glad to be here with everyone. My name is Jeremy Reedus. I am the principal and owner of Progression Services. I am an independent treasury consultant. I'm accessing 20 years worth of treasury experience from small companies, mid-sized companies, all the way up to working with the largest revenue generating company in the world, Saudi Aramco, for 5 years. Throughout my time, I've got an opportunity to witness a slew of products and technologies, and supply chain finance is definitely one of the top of my list more recently. Thanks for having me.
Yeah, thanks, Craig. Thanks for having us on here today. So Sean Van Gundy, I've been in the working capital space for a better part of 20 years as well, and worked for fintech companies, large banks, selling supply chain finance programs. But currently I work for Kroger, and everybody knows Kroger, largest pure grocer in the country, and we're on a journey of working capital and trying to manage it better and come up with better processes and things like that. So I spent a lot of time doing dynamic discounting during my fintech days, and look forward to continuing to grow in the space and learn and evolve as the industry continues to evolve.
All right, Michelle.
Thanks, Greg. Really enjoyed the conversation today. Thanks for broadening us here for the conversation with you, and especially for Sean and Jeremy. So, Michelle Branches, I'm connected to the banking industry for the last 25 years, and especially with the supply chain for the last 5 years. So it's interesting because everything the team mentioned is very connected to what we're talking to the treasurers, especially in the liquidity, cash flow, and EBITDA kind of improvement. So Monkey Tech is redefining, I would say, the working capital industry by providing a hybrid data-driven kind of platform that optimize account receivables and account payables. So providing both combinations of auction-based model and the dynamic discounting product at the same platform, we can work on both sides, and liquidity, cash flow, and strengthening suppliers, making sure that all the visibility also on the dashboards can get better, etc. So happy to talk to you and Sean and Jeremy today. Thank you so much.
Oh, it's my pleasure. So our next section is changing reality and expectations. So use the term optionality. We've mentioned going from a binary approach, pay later, receive later, pay earlier, someone else receives earlier. How do we see changes taking place in the space that supports the democratization of financing? Especially if you look back over time, the largest organizations always had access to capital. It's very hard to run some of the traditional, let's say, working capital 1.0, if we're going to use that phrase during our discussion. It's very hard for medium-sized and small firms to leverage those types of tools. And now there's other things that are helping us. New approaches, different types of technology allows for some of this additional flexibility. I would love to hear how each of you think about the optionality, or what's crucial for this democratization of capital and financing.
I'll take first step at that. I think the changing reality of this space is that one of the biggest underserved areas. Like it's easy to loan money to large companies that have a lot of money that don't need it, right? That's what banks do. They love that. It's low risk. It's easy for them. But the people that really need it are the ones that are probably underserved. And that's where I think we're even seeing the larger banks starting to go downstream and not necessarily require a UCC for every transaction because of the size, and the tenor, is pretty short in most cases. So they're taking some of that risk. And so I think that's a changing reality. I think it's also still a growing opportunity for the right organization to be able to take advantage of that, and then also create great liquidity options for those folks. But what comes with that, though, is increased risk, right? As you go downstream, your risk goes up, so then pricing becomes more of a challenge, and so then the quality of the buyer then has, for supply chain finance to really work, has to really be super solid to even get the pricing still even affordable for those people that don't have access to it. Then those that are providing the cash are, they're exposed a lot more. So I think you're going to start seeing some very unique, ways of how those are going to be insured, if you will. And it might not necessarily be insurance on that transaction, but I think that's the changing reality, is that you've got an underserved market that doesn't really and has never really had access to this type of funding before, and dynamic discounting can kind of give that access to it at pretty affordable. Supply chain finance is maybe not as affordable, but it is still a very good solution that's maybe better than the traditional funding areas that those groups have used in the past. So anyway, it's all about how can you minimize the risk for those providers of cash to that smaller, medium-sized company that historically never really had access to it.
I'll add just one note. I think that Sean hit it perfectly. I think from the supply chain finance aspect of it and looking internally, it is always the adoption of the program internally. And that does require a lifting of your procurement team, of your AP, AR. Everyone has to have a say-so in it. And also it has to have your IT components as well to make sure that everyone is connected. So if anything, that's always been a challenge. I think it kind of always will be. Then it's outward facing. It's working with your suppliers and trying to onboard them. Those things are challenges in itself. I think the macroeconomic environment we're in does help pressure the external the suppliers to want to participate, but it nonetheless is going to be a few uncomfortable conversations initially.
Amazing topics. One thing that I would add to that is the opportunity for regional banks and credit unions to join the marketplace like ours, because we understand that it's an amazing opportunity for the mid-market corporates, as you both said, that requires a different approach in terms of funders. We have talked to many regionals and credit union companies that some of them, they are not ready to support this market, but partner with fintechs, they should be able to speed up that process. So, and we understand from the opportunity talking to mid corporations, they are hungry for the credit, for the liquidity, for the cash flow opportunity. So it's an amazing opportunity. But the main point is having the right multi-funder in terms of democratizing the geography and the type of different funders into the programs.
Yeah, competition should bring better pricing. So one is maybe early stage, if you're a larger company, your suppliers can get access to capital because of your access to capital. And then the cost, what's the cost of that? How can it change over time? So tech can help let others bid on it, right? As opposed to a program that people are send in all your receivables, send in all your payables, and go from there. Now it can be more automated, more easily managed, right? There's a certain amount of overhead. If the overhead is 10, that works for the largest companies, but as you get smaller, it's like that does not work. Now the overhead is lower, so it works more effectively. All right, so the reality can change as we put other sources of capital in, other activities to help, and expectations change, right? There's increased expectation that everything will be better over time. We have spent most of our time talking about the liquidity standpoint or the balance sheet. maybe we could shift to the income statement. So the EBITDA impact. So when we talked about working capital 2.0, that's where the balance sheet impact is clear. There's more availability, everything from dynamic discounting to, I can get paid earlier, but it doesn't have to be 210. It could be, whatever, 1.95, 11, 1.90, 12, whatever those things are. But what about the impact on the income statement? How is this having a cascade impact onto the income statement? Maybe we could take dynamic discounting. We could look at auction-based supply chain financing. Maybe any of those. I'm not sure who would like to jump in first.
I'll just add that on the dynamic discounting piece, as I mentioned before, it directly does impact the earnings, the savings, because for the buyer, it's a cost of goods sold reduction. So, it's no reason to, if you have the cash, the excess cash, or you have access to a commercial paper market where it's super affordable, then you should arbitrage that and get a return on that cash, just like you would in any other expectation. So with dynamic discounting, you're going to get instead of paying the supplier $1,000, you're going to pay them $900. That's $100 savings that are going to go right to the balance sheet, or right to the income statement. So dynamic discounting definitely does impact that. I think as you go into some of the other areas with auction-based or even supply chain finance, not so much for the buyer in supply chain finance, but auction-based, it could potentially lower the pricing of that funding that traditionally had. So then maybe your interest expense gets a little bit better, and maybe some other areas. But for dynamic discounting, it's pretty clear that is a direct impact to how much things are costing you and a reduction in that cost.
Yeah, I'm happy to take the second step. I would say, yeah, you're right, Sean. We are seeing the auction-based model having a big impact for the suppliers specifically. Sometimes 20, sometimes even 40 bips in terms of lower cost based on the competition. And depends on the negotiation that the buyers, suppliers they have, that might be impact for the buyers as well. Also, from the dynamic discount, I completely agree with Sean. And even if the fintech can offer a more automated process and reduce the cost they provide for the buyer specifically, the problem can get an even more bigger impact, I would say, because we are seeing sometimes dynamic discounting provide a good impact, but the participation of the suppliers might maybe going to 12%, 11%, etc. should be and could be higher. So depend on the cost for the buyer specifically, that impact could be much higher, I would say. And most importantly, we should not say one on another kind of program. Usually we see for the big suppliers, the auction-based model are related to the low interest rate cost for them, and the mid-size lower suppliers connecting more the dynamic discount program. So having the possibility to play with those, I think is the best way to provide both liquidity and cash flow possibilities for suppliers and buyers.
Certainly gives you more flexibility. Thanks. We had one other element on here about framing cash flows, timing, liquidity's access, EBITDA's profitability. I don't think I'm going to ask a question on that. I think you guys have covered that completely, really well. I have enjoyed our conversation quite immensely. I don't want to bring it to a close, but we do need to get to the point where we wrap up. And so maybe each of you could share any closing insights you have. It could be something you've already said, something you find is very important. It could be a mindset that you would encourage other treasurers to have, or anything else on the topic that you would find useful. So who would like to go first?
I think I'll start. I believe that as a treasurer, part of our mandate, and that's not listed anywhere in our description of duties, is to educate the entire enterprise about the necessity of understanding liquidity and cash flow. It's not just a finance project. Operations has to be involved. Procurement has to be involved. It's all of us are rowing the same direction. And so for that, there needs to be that constant education about new products and opportunities that the company will benefit from. And so it's getting that tie-in and that agreement with the entire company and your fellows, your colleagues in other departments to understand exactly when I discuss about an opportunity to take advantage of, let's say, an auction-based model in supply chain finance, that no one is hems and haws about it, that they think the same as well. Treasury will be the project manager, but we definitely will need to partner with everyone else. And of course, keeping tight relationships with your AR and your AP and your IT teams, it's essential. So if nothing else, I believe the takeaway for this for all treasurers should be, you can't tackle working capital alone. The formula itself has multiple components and different departments. The best you can do is try to shepherd everyone to the same conclusion.
Excellent. Thanks so much for that, Jeremy. Sean, you want to go next?
Yeah, I think what I'd like to really do is kind of challenge everybody to think about this as, your supply base that you have as a large buyer. It's on a continuum of size of company. And then as a buyer, you really should think about, it's great to have one solution, but when you think about who really uses the different solutions that are in the space, whether that's auction-based model, whether it's dynamic discounting, whether it's supply chain finance, traditional, or maybe even P cards, which we haven't said anything about P cards in terms of working capital. There's a little element of that, but you think about the size of the supplier. I would encourage everybody to think about that. Maybe you need 3 or 4 of those to make sure that you have something that is available to those individual suppliers. And if you set those up where you're agnostic to what the supplier chooses, then you can throw it out to the supply base and say, you pick what's best for you. And we have, behind the scenes, I know as a buyer, I've got all the semantics of it all set up so that I'm getting the return that I'm expecting out of that program. But you gotta think about, the really large suppliers that you have, they're probably can borrow just as cheap as you do. But they may still be interested in some of the supply chain finance programs. And most of the banks and the providers of cash in that space, that's who they want to go spend their time on, because that's the same amount of work to get a lot of transactions. Versus down the really, really small ones, maybe that's more of your dynamic discounting, and you kind of wedge into maybe the P card space as well. But that's really the big takeaway in this whole space, is that as a buyer, you've got to think about what are all the options out there, and what does your supply base look like, and do you have the tools in place to help you optimize your working capital, your needs? Do you need your AP balance to grow? Do you need the AR to get smaller? What tools do you have in place that can fit that supply base so that you can optimize each one of those areas? Because you're never going to get all your suppliers to go into a P card, for instance. It's just not going to happen. That's not reality. So think about your supply base as a continuum, and make sure you have the tools to meet the needs of all those different levels that you have in your supply base.
Thanks, Sean. So think about your suppliers as a continuum, stratify them, and there's a suite of offerings or so that can calibrate the response. Jeremy's was about customer education, or getting your company aligned, even though you may have different drivers and motivations. If you focus on the working capital, everybody can row, I think, the same way as the term that Jeremy used. Michelle, you want to give us your final thoughts?
Yeah, I like the challenge word that just Sean mentioned. I would call the treasurers and procurement teams to really looking for what we call real timing. So today it's real possible to look not only real timing in terms of the best interest rate, but real timing visibility, real timing dashboards, real timing automation in terms of the heavy lift on the suppliers onboarding, etc. So look for that, search for that. Of course, as both mentioned about education, teamwork, and the strategic planning from both teams, it's very, very important. I would reinforce that. But I think real time is the best wording to make sure the teams look to that as well.
Real time. I guess speed matters more and more over time.
Yeah, money's key, right?
You slipped that one in there. Money is key. Awesome. Well, thank you, Jeremy. Thank you, Sean. Thank you, Michelle, for joining me on this episode of the Treasury Update podcast.
Thank you.
Thank you all.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.